Ooh. Hey everyone, Anthony here. Is it too bright, this light? I don't know. Anyway, today I'm gonna be drinking water. Today I have like a little bit of quiet time. So I really want to do live streams, but I want to do live streams with this camera, and which means upgrading this computer and getting a capture card and all that, and too much to do right now. But I want to do live streams so that I can interact with you guys while I'm making videos. And my previous live streams I've done on my phone, but I want like the quality a bit better. Anyway, this video is going to be about the Uniswap investment strategy that I kind of came up with, how to pick coins to become a liquidity provider with that you'll make the most amount of returns, make the most amount of fees, and lose the least amount of impermanent loss. I said I was going to make a video explaining impermanent loss and drawing it out and everything like that. There's videos on YouTube that already do an amazing job of explaining that, so I'm not going to get into that. But so I should have like wrote more notes and everything too. But the first thing that I have on my notes is don't pair stablecoins. And the reason for this, and I've mentioned this in my BlockFi video, what was the reason for not using stablecoins in BlockFi? Oh yeah, so in my BlockFi video, and this is the same with Uniswap, but there's more reasons not to pair stablecoins with Uniswap than with BlockFi. But when you switch out to, so when you become a liquidity provider with Uniswap, you have to give Uniswap half of one coin and half of another coin. So say, for example, you're going to become a liquidity provider for USDC, the US dollar stablecoin, and Ether. So you would have to give them equal amounts of USDC and Ether. When you do this, you're selling your Ether, you're holding a portion of USDC. So USDC being a stable coin, USDC would even be, you can say, deflationary. So holding USDC, you actually lose money by holding it because of like stimulus inflation and that type of stuff. Governments printing money printer go brrr. that meme. So when you provide liquidity to Uniswap, you're going to be holding some USDC, and you'll be holding whatever stable coin it is, like USDC, USDT, Tether, DAI. Those are all dollar stable coins. I'm sure there's like Chinese stable coins and African stable coins, whatever those currencies are. But when you're holding these stable coins, when you have stable coins, the price isn't going to go up. So if you had just held Ethereum, well, Ethereum's price is going to go up in the future. I'm a strong believer in Ethereum and and cryptocurrencies, so I want to hold good, valuable, useful cryptocurrencies. So that's the one reason, because you're selling your investment to buy a stablecoin to provide liquidity, and that's the same with BlockFi. When you invest in stablecoins in BlockFi, yeah, sure, the percent interest that you earn is greater than if you were to invest in BlockFi with Ethereum. Being stablecoins, I think USDC is like 8.6% of interest you'll earn a month, and then Ether is 5.25%, and Bitcoin being 6%. So that's the same, but there's another thing to add on with Uniswap, and that's with this impermanent loss factor that you have to take in for Uniswap. When you provide liquidity into Uniswap, impermanent loss happens when one stable coin and another stable coin, when their values differentiate too much. So if you think of like if you look at the cryptocurrency network as a whole, good coins like Bitcoin and Ethereum, not just like bubble coins or pump and dump coins, good coins that actually provide value to the cryptocurrency network and are sound cryptocurrencies that are actually useful and everything like that, they will go up together. They might not go up, like maybe Bitcoin will rise 10% in one day and Ethereum will only rise 5%. But if you, so that's with the Bitcoin and Ethereum liquidity pool. But if you have Bitcoin and USDC, if Bitcoin goes up 10%, then USDC is going to stay flat. So that divergence there between these USDC and Bitcoin is going to be 10%. But if Bitcoin goes up 10% value and Ethereum goes up 5% value, well, then that's only 5% difference there. So you'll lose less money because there's less of a divergence in the price of the cryptocurrencies. And also with like the example with Bitcoin and Ethereum, say like Bitcoin goes up 10% one day and then Ethereum goes up 5% that same day. Well, the next day, like Ethereum tends to lag behind Bitcoin and does eventually grow to match Bitcoin or become close to it. So the Bitcoin and Ether trading pair is a good one. Other than, well, let me just check to see if I have other notes about stablecoins before I move on to that. Yeah, so that's the end of stablecoins talking about that. That's why I'm not going to become a liquidity provider in stablecoins for Uniswap. So what I was saying, where I left off at saying that the BTC and ETH pair is a good one because there'll be less impermanent loss. There are some reasons why it's not really a good investment, not the best in my mind, and that there's better ones out there. Okay, so the reason why I don't think Bitcoin and ETH is a good trading pair has to do with because the way that you make money is on transaction fees with Uniswap. And with Uniswap, you are putting your liquidity, you'd be putting your BTC and your ETH into a trading pool along with tons of other people putting their BTC and ETH into this trading pool. So you get, say that you only have a 1%, you wouldn't even, 1% is a lot because right now there's $890 million of liquidity. So to have 1% is like, what's that, like $8.9 million or something. You wouldn't have 1% liquidity in BTC liquidity pair, but we'll just use that for example. So having a 1% stake in that trading pool, you would only make 1% of the trading fees. So say that there was $1,000 in trading fees done that day. Well, that day you would only make $10 in fees because that has to get split up between every other pool. I feel like my head's kind of getting ahead of itself and I'm not really explaining this properly. But you only get a portion of the fees in the pool. And because the liquidity cap, because the amount of liquidity in BTC and ETH is so high, you'll only have a small stake in the pool because chances of you having $9 million to make 1% of the total fees, people just don't have $9 million to dump into this. So that's one reason, and we can see like right here, 890 million. The next thing, volume in the last, because you want to find a pool that has a lot of trading volume, because the more trading volume there is, then the more fees you're going to be making because there's more volume on the exchange, more volume, more fees. So what we see here, out of $890 million, only $196 million was traded in the last 7 days. last 24 hours, $54 million. And that puts, I guess, 1 year estimation of fees at 7.32%. Now, if we look at this Pickle token, and I don't know what Pickle token is, I'm not telling you to invest in it. I'm not telling you that it's a good coin or anything. I'm just using this as an example. So if we look at Pickle token, well, we see that the percentage is much lower in that, well, there's only $24 million of liquidity, and in the last 7 days, 18% of, or not 18%, 19 million dollars of that $23 million was traded. So that's like over half. Let me do a quick calculation and see what that is. So I always get this mixed up. 19 divided by 24, or is it 24 divided by 19? Yeah, so 79% of the pool was traded. But meanwhile, on Bitcoin, we do 197 divided by 890. And we see that only 22% of the liquidity was traded. So there's much higher trading volume with this Pickle token. And again, not saying invest in Pickle token. I'm just using this as an example. So that's what you want to look for. You want to look for a coin that has a lot of trading volume and low liquidity in the pool. Something that has a high percent of trades happening. For whatever reason, I don't really know, I guess, how this works, but because this is a 1 year trading fees, but it's at 7%. I think that's because transaction volume is still low and on this. But then let's see, like another one. We can look at this Chainlink token, and this Chainlink token. This was at like, I think 70% yesterday, but this is another one. 27 days is trading more than the liquidity that's actually in the pool. So 24 divided by 21, and 114% more. So that would be a good one to invest in based on those numbers and everything. Now there can be, let me see if I can find it. There can be coins where it will have a lot of transaction volume, but like I said, they're not stable and proven coins. They could just be like a fad coin. I guess people call them like shit coins or whatever, but it could just be something that like popped up and got everyone excited, got a ton of hype behind it, and then for whatever reason the project failed, or didn't, the hype didn't sustain and it wasn't as valuable as people anticipated it. I don't know anything about this Keeper coin, but this is one that I'm saying shows signs of that, because this coin definitely just popped up. Everyone got super excited about it. It was making like 350, 400% fees. If we, let me switch real quick to another screen. Yeah, so if we look at uniswaproi.com, we see, I mean, now there's a new one up, but it was like 300 and something percent yield. So you don't want a coin that doesn't have stable volume either. When we add all this together, so you don't want stable coins, you don't want stable coins, you want a coin that value will rise along with the trading pair that you're doing. So if you're investing, if you want Ether as your starting pair, well, Ether and BTC, BTC doesn't support the Ethereum network. Now, if there was a token on Ethereum that actually provided value to the Ethereum network, well, then that token is going to go up along with Ether. So Chainlink is a good example of this, because Chainlink provides oracles for Ethereum, and oracles are pretty much, how do I explain this? Oracles, I guess you can say, let Ethereum access real world information. So say that you write a smart contract, and the smart contract is programmed to send money as soon as the next president is decided. So say like there's a smart contract that says give Anthony $100 when Donald Trump is elected president. Well, then the Oracle will be able to take that outside world information, source of information, and plug it into the Ethereum network to provide that information in order for that smart contract to work. So Chainlink is one that I see that provides good value, and that will go up with Ethereum because it's a useful token for Ethereum. Another one that I'm looking at is the Uniswap token, because Uniswap also provides value to Ethereum by being the governance layer, the governance token layer for Uniswap. So I think that's, in a nutshell, I think that's the best trading strategy for investing in Uniswap. I don't know how well it'll work out in the long run or anything, but it seems to me like the best strategy is to make liquidity pairs that with tokens that are valuable to the Ethereum network, because then both coins will rise at the same time. Who knows, maybe, but that's not guaranteed either, because maybe Chainlink gets like a news story or something that, or gets like some huge, say that Amazon decides to do like a $12 billion contract with Uniswap to implement Uniswap, and is doing like $12 billion of volume a year or something because of, or not Uniswap, because of Chainlink. Well, then that news will make Chainlink rise much faster than Ethereum, though it would still be using the Ethereum network in that situation, because Chainlink, I've read that Chainlink can also be used on other networks, Polkadot being one, but then I've also read otherwise. We're not going to get into that, but Ethereum would also rise with Chainlink, because Chainlink would be used on the Ethereum network if the case of Amazon is using the Ethereum network with Chainlink. So that seems like, let's just end this video. That's my thoughts. That's what I think is the best investment strategy for Ethereum. That's the reasons why. Last thing that I want to touch on is that I noticed this today. Oh, and like I said, I don't know if this is a good strategy. These are just my thoughts. I don't know how well it will work in practice. But yeah, the last thing I wanted to touch on, which should be like a totally different topic, so never mind, we're not going to talk about it. But it's, the basis is that I'm going to show you my where are we? I'm going to show you my my USDC to Ether trading pair, and it'll provide an example to this. So if we look here, and I'm using liquidity.vision to pull up this information, but if we look here, I'm actually negative on the USDC Ether trading pair by $1.18, and this is after having it in there about a week. And look at how much Ether I lost. I lost 0.78 Ether, because people are buying my Ether with their USDC. So I'm getting the USDC and they're getting the Ether. Was it 0.078 times for about 410, and that I lost $39 or $32 because of this. But you can say like, oh, well, you just use this USDC to buy that Ether back. Well, how much? So $32 to buy back $32 to buy back 0.078 Ether. Let me gain my train of thought again here. So all right, so $32 and 240 minus 219, and I only have $21 in profit to buy back $32 of Ether. And then there's also the 0.03 or 0.3% trading fee on top of that to buy back So I'm gonna let this run for a month and see what happens. But I think it's a bad idea to do that because of this impermanent loss that I'm being hit with. So yeah, luckily I only put in $400, I guess, $437. All right, take care, guys. Thank you, and goodbye.